In the commercial sector, the bottom line is profit. In the not-for-profit sector, the bottom line is purpose, public trust, and absolute transparency. But executing that purpose requires navigating one of the most complex regulatory and financial reporting frameworks in Australia. Today, we are moving past the basics. We are taking a deep dive into the technical nuances of NFP accounting, specifically the collision between AASB 15 and AASB 1058, and mapping out an auditor-grade blueprint to bulletproof your organization ahead of your next statutory audit. Whether you are a financial controller preparing the files, or an auditor assessing the risks, this video is for you. Before we touch a single ledger, we have to understand the compliance ecosystem. The Australian Charities and Not-for-Profits Commission, ACNC, is the apex regulator, but they are rarely the only one. Depending on your structure, you might also be answering to state and territory regulators for incorporated associations, ASIC for public companies limited by guarantee, or ORIC for indigenous corporations. Let's look at the ACNC reporting thresholds, which dictate your baseline audit obligations. Crucially, even if the ACNC categorizes you as medium and allows a review, your state regulator or a major Commonwealth grant agreement may legally compel a full audit. Always map your highest level of compliance. The single biggest area of audit adjustment in the NFP space is revenue recognition. When a grant hits the bank account, you have to ask two critical questions. Is the agreement enforceable, and are the performance obligations sufficiently specific? Let's break down how this dictates your accounting treatment. AASB 15, revenue from contracts with customers. If a government department gives you $500,000 to deliver exactly 50 mental health workshops over 12 months, and holds the right to demand a refund if you fail, that is AASB 15. The revenue goes to the balance sheet as a contract liability. You only recognize the income in the P&L as you actually deliver those workshops. AASB 1058, income of not-for-profit entities. Conversely, if a philanthropist leaves you $500,000 to support your general mission, or a grant lacks a refund clause or specific delivery metrics, it falls under AASB 1058. That revenue must generally be recognized immediately in the P&L as income, even if you plan to spend it next year. There is one major exception in AASB 1058, capital grants. If you receive funds specifically to construct or acquire a recognizable non-financial asset, like building a new community center, you defer that income as a liability and recognize it as revenue as the asset is built. Revenue isn't the only trap. Let's look at three other standards where NFPs frequently stumble. Peppercorn leases, AASB 16, many NFPs rent council buildings for $1 a year. While the AASB currently provides temporary relief allowing NFPs to measure these right-of-use assets at cost, essentially zero, you must still provide extensive qualitative disclosures about your dependency on these concessionary leases. Volunteer services, AASB 1058, do you recognize volunteer hours on the P&L? Only if your organization is dependent on those services, they would be purchased if not donated, and their fair value can be measured reliably. Otherwise, keep it to the notes. Related party disclosures, AASB 124, for Tier 1 and Tier 2 general purpose financial statements, key management personnel, KMP, remuneration must be disclosed in aggregate. This requires strict tracking of salaries, superannuation, and non-monetary benefits for your CEO and board. Now, let's flip the perspective. If I am the external auditor, I am designing my audit procedures based on the Australian Auditing Standards, ASAs. Here is exactly what I am testing. ASA 240, Fraud Risk and Revenue. Auditors presume a risk of fraud in revenue recognition. They will test your controls over cash donations, opening the mail, banking procedures, and issuing receipts. If you lack segregation of duties here, expect a management letter point. ASA 315, Identifying risk via internal controls. In smaller NFPs, a single finance manager might process payroll, pay suppliers, and reconcile the bank. That is a massive control deficiency. Auditors will look for compensating controls, like the board treasurer independently reviewing bank audit logs. ASA 570, Going Concern. If 80% of your funding comes from a single government contract expiring in 3 months, the auditor must assess if you are a going concern. You need to provide cash flow forecasts extending at least 12 months past the audit report date. To guarantee a clean, efficient audit, you need to transition from reactive bookkeeping to proactive audit management. Execute this checklist 30 days before the auditors arrive. 1. The grant acquittal tie-out. Your deferred revenue schedule on the balance sheet must perfectly mirror the unspent funds reported in your acquittals submitted to funding bodies. If they don't match, the auditor will halt. 2. Payroll and entitlements audit. Run a recalculation of your long service leave provisions based on the latest state-specific portable long service leave schemes, if applicable. Ensure superannuation guarantee (SG) payments match the latest statutory rates. 3. The subsequent events review. Under AASB 110, you must disclose significant events occurring after the reporting date but before the financials are signed. Have you lost a major grant? Signed a new property lease? Document it. 4. The workpaper master file. Don't make the auditor hunt for data. Provide a digitized, indexed folder containing all new or varied grant agreements, signed board meeting minutes for the full 12 months, the updated fixed asset register, including impairment assessments, extracts of the latest ACNC charity register showing active compliance. A well-prepared NFP doesn't just survive an audit, it uses the audit to demonstrate financial maturity to its donors, its board, and the public. By mastering AASB 15 and 1058, locking down your internal controls, and anticipating the auditor's requests, you turn a compliance exercise into a strategic advantage. If this deep dive added value to your technical toolkit, make sure to subscribe to the channel for more comprehensive breakdowns on financial reporting and auditing standards. Leave your specific NFP accounting questions in the comments below, and I'll see you in the next video.